We have now completed 2021 and it has been another roller coaster ride. From an economic point of view, COVID's second wave was very disastrous. However, we have overcome the second wave and have emerged even stronger than before. And from stock market point of view, this has been another great year. Nifty jumped from 14,000 in January to 18,500 in October, generating a return of around 32%. So that was a huge rally in the initial 10 months of this year. But then we saw a correction of 10% when Nifty touched the levels of 16,500 for the next 2 months. Although in the last couple of weeks, the market has again recovered and Nifty has crossed the levels of 17,200. So overall Nifty has generated a return of 23% in 2021. Well, that's a brilliant performance. Now obviously, it is not that all 50 companies generated an equal return of 23%. So I tried to understand the outperformers and underperformers for 2021. Hello friends, my name is Sahil and this is my Personal Finance Academy. Now that we are entering 2022, I wish you all a very happy and prosperous new year. I hope this new year creates more wealth for you and at the same time keeps you healthy. If you have been following my videos in 2021, you would know that I have a background in data analytics and I love to do number crunching and generate insights. So I thought of analyzing the top 50 companies of Nifty and sharing my observation with you all. Now what I did is I created an Excel sheet of Nifty 50 stock and noted down their valuation, last 3.5 year growth, 3.5 year profitability along with return in last 1 year. The reason why I included 3.5 year growth is because COVID had badly impacted a lot of sectors last year. So it won't be right to compare profit growth with last year. By the way, you can access this Excel sheet for free on my website sahilbhadviya.in along with the top 100 plus stock live tracker that I have updated recently. Alright, let's get started with today's topic. Although Nifty is trading at a PE of 23.7, there are 13 stocks that are trading at a PE of more than 50, 15 stocks in the range of 25 to 50 and 21 stocks trading at a PE of less than 25. One stock PE cannot be calculated as its earnings are negative. Now generally a company commands high PE due to multiple factors like leadership position in the sector, high growth in the past along with bright growth prospect in the future and its high profitability. On the other hand, a company might be available at low PE due to factors like poor growth in the past and weaker growth prospects in the future. But since in the short term, market is driven by sentiments, some stocks could become overvalued where the investors are willing to pay a premium more than the company actually deserves. Similarly, some stocks could become undervalued due to negative sentiments and available at attractive prices. Although valuation is a very subjective game as it not only includes past performance but also involves future performance that nobody can predict with 100% conviction. But let us look at the top 10 costliest stocks in terms of PE ratio and try to analyze the reason for it. Likewise, we'll look at the top 10 cheapest stocks in terms of PE ratio. So number one stock is Airtel and it is trading at a PE of 125. Now in case of Airtel, it is not highly profitable. In fact, it was in huge losses between 2020 and 21 and we all know the reason for it, the stiff competition from Jio. And the race to capture the world's largest telecom market and probably the world's most potential telecom market in terms of growth. And the telecom sector is highly capital intensive. We know that over the past few years, all telecom companies went bankrupt and only 3 companies survived. The third company is Vodafone Idea, that is a merger of Vodafone, which is one of the world's largest telecom company, and Idea, which is part of one of India's biggest business house, Birla Group. Yet, Vodafone Idea was almost on the verge of bankruptcy until government provided some support recently. That resulted in only 2 major players in the Indian telecom sector, Jio and Airtel. And Airtel has not only managed to survive, but it has also become profitable again. In fact, its last 3 year profit growth is 33%, which is brilliant. In 2020, Airtel reported a loss of 32,183 crore, but this loss got reduced to 15,084 crore in 21 and in the last 12 months, Airtel has reported a profit of 3,030 crore. So the reason why Airtel is commanding a high premium is because the telecom sector in India is an oligopolistic market controlled by a few players. There is no doubt that telecom sector has very high potential. After the last few years of struggle, Airtel is back on profitable growth trajectory, and it seems the market is betting on Airtel to benefit from the telecom and digital revolution in India. Now, second stock is Titan. It is trading at a P of 122. Now, why is Titan commanding a high premium of 122? Well, again, Titan is not growing at a very rapid rate. In last 3.5 years, its growth has been around 13%, although its ROE and ROCE are well above 20%. So one of the reasons for premium is that consumption is one of the biggest theme in India, and Titan is the leader in jewelry and watch segment in India and already among the top players in eyewear category and even in perfume segment. It has also forayed into the sari segment. But for me, a PE of 122 for Titan is highly overvalued. Then third stock is HDFC Life, which is trading at a PE of 115. One of the reasons for high PE of HDFC Life is fall in earnings. Due to COVID, the profitability of life insurance companies got impacted due to a lot of medical and life claims. However, on the brighter side, COVID has also increased the awareness for life and health insurance. In fact, HDFC Life is one of the underperformer in 2021 with 5% fall in share price. In spite of that, both DII and FII have increased their shareholding in the company in September quarter. The number 4 stock is Asian Paints with a PE of 99. Now, what could be the reason for high premium for Asian Paints? Well, first is that it has a leadership position in Indian decorative paint category, and this sector has a bright growth prospect due to increasing demand for paint in new houses and commercial buildings. It is a household name in India. Then second is, it is highly profitable company with a 3-year average ROE of 26.4 and 3-year average ROCE of 34.4. Although the 3-year profit growth is average at 14.3%. Now for me, Asian Paints earnings are not growing at an exceptional rate that it deserves a PE of 99. So that's overvalued for me. Then fifth stock is SBI Life. It is trading at a PE of 96. Again, the reasons are similar to HDFC Life. Due to COVID, profitability got impacted, but the future growth prospects are good. But should it command a PE of 96? Well, that's a big question. Now, number 6 stock is Tata Consumer, trading at a PE of 86. In last 3.5 years, its profits have grown at a CAGR of 11.5% and both ROE and ROCE are below 15%. I guess the reason is because investors are bullish on Tata Group and its leadership. There is no doubt that Tata Consumer has a bright growth prospect, but at current valuation, it is certainly looking costly. Now, 7th stock is Bajaj Finance. It is trading at a PE of 84. Well, one of the reasons for high premium for Bajaj Finance is due to its leadership position in NBFC space. This company has grown at a fantastic rate with profit growth of 42% between 2015 till 2020. However, since COVID, its profitability got impacted and even there was a rise in NPS. During COVID, Bajaj Finance fell from levels of 5,000 to levels of 1,800. But now the share is trading in the range of 6,800. Sure, the growth prospects are bright, but the question is it worth paying a premium of 84 times price to earning multiple? Well, for me, that's high valuation. Then number 8 stock is Nestle. It is trading at a PE of 83.6. So Nestle is one of the most profitable company with 3-year average ROE of 68% and ROCE of 96%. But as far as growth is concerned, company has struggled to grow at a fast rate. Its last 3.5 year CAGR profit growth is 10%. So for me, a PE of 83.6 for already a large cap company with slow growth is very high. The 9th stock is HUL. It is trading at a PE of 64. Again, HUL is one of the most profitable company with 3-year average ROE of 48% and ROCE of 67%. But as far as growth is concerned, its last 3.5 year CAGR profit growth is 14.6%. Sure, HUL deserves to command a premium valuation due to its leadership position in FMCG sector, but the growth is not that high. Due to that, HUL has been a laggard with a fall of 3% in last 1 year. Number 10 stock is Bajaj Finserv. It is trading at a PE of 61. Again, growth in last 3.5 years has been average with 14% CAGR profit growth and profitability is also average with 3-year average ROE of 13.3%. Hence, it looks expensive to me at current valuation. Overall, there are 3-4 quick observations. First is, market is giving a premium to industry leaders, be it Asian Paints, Titan, Bajaj Finance, HUL, etc. Second, FMCG stocks are available at premium valuation. Out of 10 stocks, 3 stocks are from FMCG sector, Tata Consumer, Nestle and HUL. Then third, life insurance companies are available at high PE. It is due to their lower earning due to COVID but brighter growth prospects in the future. And the market is also rewarding Airtel due to its strong presence in the Indian telecom sector that is mainly oligopolistic. Now, I don't want to do analysis of individual stocks with lowest valuation, but I want to share some quick observation. First observation is that out of top 10 stocks with lowest PE ratio, 6 companies are public listed companies. IOCL trading at a PE of 4, BPCL trading at a PE of 4.3, ONGC trading at a PE of 4.8, Coal India trading at a PE of 6.5, NTPC trading at a PE of 8.8 and Power Grid trading at a PE of 8.7. This clearly suggests that investors do not prefer PSUs and hence they are not willing to pay higher price for earnings these PSU generates. Then second observation is that out of top 10 stocks with lowest PE, 5 stocks have businesses in non-renewable sector. 3 companies are in oil marketing, IOCL, BPCL and ONGC, 1 in coal mining that is Coal India and 1 is majorly in power generation from coal that is NTPC. So clearly investors are avoiding companies with major businesses in non-renewable sector. Then third observation is that investors do not prefer to pay a high premium to metal stocks. You have Tata Steel, JSW Steel and Hindalco. So 2021 has been amazing for metal stocks and all 3 stocks, Tata Steel, JSW and Hindalco have been among the top 10 wealth creator in Nifty 50 stocks for 2021. However, in spite of increase in share price, the P ratio is not high because there is a sharp increase in earnings for metal stocks. But everyone knows that metal stocks are cyclical and hence investors are cautious with metal stocks. The number 4th observation is that investors are cautious towards two-wheeler auto sector. There is a big disruption in auto sector with electric vehicle theme and there is no guarantee that a leader in traditional auto category would continue to lead the EV sector. Due to that, investors are in wait and watch mode and not paying a premium to stocks like Bajaj Auto and Hero Moto. Hence, both auto stocks are trading at an all-time low and available at very low valuation. Bajaj Auto has a PE of 14 and Hero Moto has a PE of 16.6. It would be interesting to see if Bajaj Auto and Hero Moto would be able to lead the electric vehicle sector or not. Personally, I believe that both these companies would eventually do well as they have a very experienced team along with an extensive dealer network and they are a household name in every part of the country. And of course, they have the financial strength as well. Although another reason for low valuation is due to poor earning growth in the past as auto sector has faced a lot of challenges and the latest challenge has been the chip shortage. But all eyes on quarterly performance of auto sector. Now that we are talking about auto sector, do you know which company has generated the highest return in Nifty 50 category in last 1 year? Well, let me give you a hint. It is from auto sector. It is Tata Motors. Tata Motors has generated an exceptional return of 155% in last 1 year. Tata Motor has emerged as a leader in 4-wheeler EV segment and market has rewarded Tata Motor investor with great return. On the other hand, the worst performer of 2021 in Nifty 50 category is Hero MotoCorp with minus 22% return. Now obviously, a PE of 5 or 10 does not necessarily mean the company is undervalued. You need to look at the growth rate of the company, you need to look at the profitability of the company and of course, you need to look at the future growth prospects. So far, we have covered 8 insights. I have 2 more insights from this analysis. 9th insight is that the IT sector has outperformed the Nifty 50 index. All 5 IT companies have generated more than average return in Nifty 50. Wipro and Tech Mahindra have completely outperformed and generated a return of 84% in 2021. Then HCL generated 37% return, Infosys generated 50% return and TCS returns were 27%. The reason I could see is Wipro, Tech Mahindra and HCL were available at better valuation at the beginning of the year as compared to Infosys and TCS. And I believe that IT sector would continue to outperform the Nifty 50 index in 2022 as well. Then there is one sector that has done well in terms of profit growth but still looking very reasonable in terms of valuation. It is banking sector. For example, SBI Bank has given a CAGR profit growth of 89% in last 3.5 years. Yet, it is available at a PE of 14.29. ICICI Bank 3.5 year profit growth has been 33.6%, yet it is available at a PE of 24. HDFC Bank 3.5 year profit growth is 19.2%, yet it is available at a PE of 23.5. So from a sectoral perspective, banking sector is looking attractive at current valuation. Now let us conclude the top 10 insights from Nifty 2021 performance. First is, although Nifty at a very high level is looking attractive at an average PE of 23.7, but within that, 13 stocks are trading at a PE of more than 50, 15 stocks are trading within the range of 25 to 50, and 21 stocks trading below PE of 25. Second, market has given a premium to industry leaders, and this trend can continue in 2022. Then third, in spite of relatively slower growth, FMCG stocks are still trading at premium valuation. Although HUL has been one of the worst performer in 2021 with a negative return, except for ITC, which is probably the biggest meme stock for 2021. Then fourth, life insurance companies are available at a high PE. It is due to their lower earning due to COVID, but brighter growth prospects in the future. Then fifth, market has rewarded Airtel due to its strong presence in the oligopolistic Indian telecom sector that has a bright growth prospect. Then sixth, the PSU companies are still available at a very low valuation, and it seems the market is not willing to pay a premium to PSU companies. Then seventh, metal stocks have been the outperformer due to rise in commodity prices. Then eighth, market is very cautious towards the EV revolution in auto sector. On one side, Bajaj Auto, Hero Moto and Maruti have been well destroyer due to lack of clarity towards EV progress, whereas on another side, Tata Motor has been the biggest wealth creator within Nifty 50 for 2021 due to its leadership in EV segment. Ninth, IT sector has been a wealth creator with all IT stocks generating more than average return of Nifty 50. And 10th, banking sector has grown at a decent pace, but this sector is still available at attractive valuation. So what is your biggest insight from Nifty 50 performance in 2021? And what are your expectations from 2022? Tell me in the comments. If you want to learn more about money management, you can explore my online course on money management. I will see you in next video. Till then, take care.